everybody, and a warm welcome to our webinar. My name is Murray Anderson from Prescient Investment Management. I look after the retail business. This is our first webinar for 2026, covering Q1 events. Today with me are Bastian, our CIO, Shreya, Portfolio Manager in our multi-asset team, and Dimple, quick equity analyst in the equities team. Before we start, if we just reflect back on where we've come from, last year we had a very strong South African equity market. If we looked at the backdrop for South Africa, it was very exciting. We had inflation coming down. We were on an interest rate cycle that was definitely a cutting cycle. There was lots of positive sentiment. But obviously we came into Q1 and that all changed with what's been going on in the Middle East. So that really puts us on a very interesting trajectory going forward. So today's webinar, we'll cover where we've come from, a little bit of the valuation metrics that we've been looking at, and obviously talk about asset classes going forward, given the conflict and the geopolitical issues that we're facing globally. It's not only an inflation and interest rate question. We used to think money was going to flow into South Africa, but obviously with valuations changing around the world so quickly, the question mark going forward is, where's the value to be found now? So Bastian, turning to you, as I mentioned, we had this amazing equity market performance from South African equities. We then came into the new year and we had the Middle East conflict, obviously the Iranian attacks. Obviously then equities generally around the world started to nosedive, unfortunately. Give us a bit of a reflection on where we came from and where we're sitting at the moment.
Yeah, thanks Murray, and thanks everyone for joining. I think interesting again this year, actually quite similar to last year, that we have a lot of geopolitical talk, geopolitical risks materializing, a lot of noise. This time, other than last year, asset prices do react. But despite all of that, we think that under the hood, if you look at the fundamentals, not that much has actually changed. Certainly the perception has changed, certainly the flow of money has changed, and we can see it in higher interest rates being priced for the future. We can see it in equities, obviously, now having sold off, emerging market currencies being weaker, credit spreads widened a little bit on the margin though. But the reality is we still see a strong global economy. We still see inflation as benign, at least after a short spike based on the oil price. So with all of that, yes, asset prices have changed or reflect the uncertainty, but not too much has changed in terms of the backdrop.
It's quite interesting to see the fundamentals are still relatively strong. I mean, the S&P 500 looks particularly strong. We have seen some reaction in South Africa. I guess there are sectors that have been under pressure, and we'll cover a little bit of the South African equity position a little bit later on in our webinar. But Bastian, maybe just talking about multi-asset portfolios particularly, and where do we position assets right now?
Yeah, that's a good point. So we went into the crisis quite conservatively, so that obviously helped us by being slightly underweight on equities in general. We've been slightly more cautious also on the risky fixed income part, so on the emerging market bonds, on South African government bonds, being slightly more positioned at the front end of the yield curve. So all of that quite positive, but that has changed now a little bit, taking a slightly more optimistic stance. So if we take a quick look at our asset overview, you will see that it's kind of a mixed picture in terms of how we position for equities. So basically on the right hand side, positive on South African equities, slightly more cautious on developed markets, slightly more optimistic on emerging markets. So if equities, then more the emerging world. If we drill into the emerging market equities, slightly more negative on US, slightly more neutral on Europe. I think it gets slightly more interesting if we scroll down a little bit, look into the fixed income space. SA bonds you can see in neutral, but as we drill in a little bit more details, you can see the positive stance on the front end of the curve, neutral stance at the back end of the curve. And then for the US bonds, we've got a slightly more optimistic stance. We like bonds a little bit more, and that's across the curve. Last but not least, I'm going to skip that credit section for a moment. I'm slightly positive on the rand at these current levels, but also very interestingly, I think, strong positive view on the whole SA money market curve, so basically the front end of the yield curve. So basically, yeah, kind of neutral stance on equities, more optimistic on the fixed income space, particularly optimistic on the front end of the fixed income curves, particularly in South Africa. So what has changed is slightly more optimistic than before the crisis, but I think more interestingly, a little bit of a shift towards favoring fixed income over equities in that current environment.
Bastian, the issue that we really face is a high oil price, which has an implication for inflation around the world. If you think of the US was particularly in potentially a cutting cycle, definitely a cutting cycle in South Africa, that's all changed. The expectations for inflation have increased. You spoke about the front end of the curve, so that's where you're finding opportunity.
That's exactly right, and I think the narrative around inflation has changed dramatically, and we like the fact. So with a systematic investment approach, what we like is the narrative changes dramatically, but the facts under the hood maybe not. So that's almost like a mispricing. So we like the fact that everybody talks inflation, that everybody's worried about inflation, while our stance on inflation has actually not changed, that inflation is not really an issue. So normally we speak about inflation first and then how asset prices have reacted or what the front end of the curve is pricing. This time I'm going to do it slightly other way around. So we're going to start by looking at what the Fed is priced for. So on the dark blue line you can see that right now it's priced for not too many cuts, no cuts actually. The red line is the current level of interest rates, the blue line where we are priced into the foreseeable future. And you can see only at the end of next year that's where we start to see cuts again. So you're right, Murray, exactly. That there's been a lot of cuts taken out. Those were the cuts which we had in the system previously before the crisis. So basically crystal clear to see that a lot of the cuts have been priced out. But remember now that means we're investing at higher rates, which we like. Before we go there, let's shift to South Africa. Same picture. Just going to take some of these dots out and focus on the same story. 6 months ago we priced for interest rate cuts. Again, the red line is the midpoint of the current pricing, so basically where interest rates are set. 6 months ago we priced for cuts, today we priced for hikes. And that creates opportunity right there. If you don't believe that these cuts will be delivered, you can see a sweet spot here, like call it 1 year out or maybe 1.5 years or 9 months, and that's exactly that part of the curve which we favor a lot because we think that there's a lot of hikes priced and there's no reason for those hikes to be delivered. There might actually even be cuts. But before I go further, I want to look into the inflation backdrop, and that's delivering the reason why we believe that there's no reason to think about interest rate hikes. So going to bring this up for the United States, and just for the interest of time actually focus on the United States and just look into inflation expectations. So that's basically telling us where interest rates are going to be in the future, or where the market thinks interest rates are going to be in the future. We're going to look into inflation swaps, which is the easiest and cleanest way to price for that. And if you look into the 1 year inflation swap and just focus on the right hand side, just before the crisis we had expectations for inflation to be at around 2.5%, and right now we have expectations of inflation in the United States to be at 3.2%. So there's a 70 bips increase, which is measurable, but it's not materially as we think. It's quite something, but it's not dramatic. But the more interesting story is that this is all on the 1 year. We bring in the 5 year, you can see that 5 year inflation expectations have not changed at all. If anything, they have actually dropped over the last couple of weeks since we had the crisis starting. So long story short, what we are seeing, Murray, is that we've certainly been priced for high interest rates, but we don't really see reason to be more pessimistic on inflation. So basically, Murray, what we can see is we've been priced for hikes. We don't think there's any reason for hikes. Potentially there's still reason for cuts. The shock itself is purely supply side driven, quite similar to actually post-COVID. And what we should expect in a pure supply side shock is not that the Fed reacts or the SARB reacts with high interest rates. They must look through that, and we think that this is exactly what's going to happen this time, that the reserve banks in South Africa but also the Fed are going to be slightly smarter about this time around.
Thanks, Bastian. Shia, turning to you, to put this complex puzzle together in a multi-asset portfolio is, I guess, quite challenging in times like this. So you start with a strategic asset allocation, you have long-range forecasts for asset classes, but you have a shock like this coming into the system, and I guess everything is turned upside down. How do you factor this and then consider valuations and the portfolio construction process given times like this?
Thanks, Murray. So yes, I mean, in times of crisis, it certainly feels as though everything should be upside down and we should be panicking. But one of the benefits of our systematic process is that we shouldn't actually be feeling like that. So the process should show us or guide us in terms of our asset allocation, especially in times like these. So what has happened, what's moved, our tactical asset allocation models are quite quick to react to any big moves in the market, and that's exactly what it's designed to do, to be able to capture shorter term opportunities. And over the past month, what we've seen, if you think about how we look at asset classes, so we look at valuations, how are markets pricing for equities, bonds, etc. We look at economics, so what is the economic growth outlook, what does the landscape currently look like. We look at financial conditions, so their monetary policy, Fed balance sheet, the likes, and then we also look at sentiment. Now, out of those four, valuations and sentiment have picked up signals over this time. So the first one, valuations, that's pretty simple to understand. So their markets sell off, your equities become more attractive because they're trading at lower, for example, PE multiples or price to sales ratios. Your bonds become more attractive because the curve moves up and you have more attractive real yields. From the sentiment side, it's not as obvious, because why would we be more positive on sentiment if there's a crisis or a war? And that's exactly how we actually use the indicator. So how we measure sentiment is through something called implied volatility. That's just a fancy way of saying we measure the market's uncertainty, because implied volatility is essentially measuring how much the market is willing to pay up for insurance on unfavorable asset class moves. So when we are in a normal market scenario, things are just ticking along. And if you've watched these webinars, then you'll know we've been saying for quite some time that the market's been quite complacent. And in times of crisis, so 2008, COVID, Liberation Day, and now in March, we've seen our implied volatility spike. And it's those spikes that actually trigger a signal. When it spikes, it means that the market's quite worried, they're willing to pay up quite a lot, they're overly pessimistic. That's a signal for us to actually put risk on. So if you think about currency markets, bond markets, equity markets, that's where the signal features, and that is a signal for us to go more into those asset classes. And the reason for that is because naturally markets are quite overreactive, and what actually plays out is normally not as bad. So from the sentiment side, that's what we've picked up. From the valuation side, it's become more attractive. Economics, as Bastian mentioned, pretty resilient, and financial conditions overall have been quite tight.
Thanks, Shreya. Very insightful. So just to recap then, at the back end of last year, you were more defensive because implied volatility was low, indicating that you felt, well, we felt from a systematic perspective that the market was undervaluing potential opportunities could play out. That obviously all changed, as we know very well. How did you change positioning then according to what our indicators were leading us to lean into?
Sure. So yes, so coming into March, we were more defensively positioned. We actually took risk off the table and were tilted more into income asset classes, particularly onshore, so SA income, as well as developed market income. But your SA income was giving you north of 8%. And if you looked at the amount of risk that you have to take on in the equity market at the time, it just wasn't warranted. So for us, it's all about risk and how we can control it, or manage it in a way where we're not actually giving up return. So coming into March then, things obviously changed with valuations and sentiment, and what we actually did then is tilt out of income and now put a little bit more risk on, so tilt a little bit into SA property, tilt a little bit into developed market equity, where we're actually quite underweight. And then we also put on a little bit more SA bond exposure, as well as also putting on a little bit more duration. So as Bastian mentioned, we are quite bullish on the front end of the curve, but throughout the month of March, the back end of the curve was very attractive. And so we moved from the belly and put on a little bit more towards the back end. Now what's happened is that the curve has shifted down, and as you saw, our views are neutral. And so for us, it was an opportunity that we'd taken advantage of.
Thanks, Shreya, for that explanation. Dimple, turning to you in the equity markets, I mean, we saw even in the domestic equity market, there was a significant sell-off off the back of this escalating Middle East crisis. And that really, obviously from a South African sector perspective, has had significant impact. Given where we are now, what are you, the equity team, seeing, and how are we positioning ourselves?
Thanks, Murray. So the first quarter definitely was a reminder of the fact that equity markets are more a long-term game. the first quarter would have caused a little bit of a shock to our investors. And so in such volatile markets, this is where your process really gets tested. Yeah, so looking at the performance of the markets year to date, I think the all share has only gone down 0.6%. I think in the midst of a crisis, in the midst of such volatile markets, to say that at the end of it, or not at the end of it, but in the midst of it, that we're still down quite 0.6%, it's quite a resilient story. It shows the strength of equity markets, and as Bastian has mentioned, that the fundamentals haven't really changed. So really what we're seeing, both on the local and the global side, is that this is quite a sentiment-driven sell-off. The global markets have also quite been hit a lot more harder, with about 3.5% down quarter to date. But we're already now in April seeing the rebound. We are moving more towards the positive side of things. And so there isn't a cause for concern at the moment. And if I dig deeper into the actual different sectors, the ones that were hit the most were, one, technology. So technology already, even before the Middle East crisis, was already quite hit, and that's okay, because we've seen that it was a star player for quite some time, and naturally in equity markets there is an element of mean reversion. So on top of that, yes, the crisis is at hand, but we do expect that the equity market would be a little more volatile. The other sector that was quite hit was also the property market, was down about 5%. But all of that is still not too concerning, especially if you're invested in the index, in the market, because, for instance, basic material, even through all of this, has done really well. Basic materials has performed about 5.7%, which is quite positive, and with the kind of diversification that you would want as an investor. So yeah, just to reiterate, yes, performance is up and down, and a 22% down in technology would cause a little bit of a panic, but however, you don't just look at short term, especially in equities. You're looking at investing for a long period, long horizon. The 1 year numbers are still quite incredible from the last year. Yeah, so you need to just stick to the process that you've set in place and see the market redeem itself.
Dimple, thanks for that. I mean, really, to me, what you've described effectively is obviously equities, for the long run are important in a portfolio. I mean, they're a key component to a balanced portfolio as a long-term strategic asset allocation and long-term growth. But the other emphasis here is that sectors themselves will have times in market conditions when one would outperform the other. And so you have a significant amount of volatility around the equity market cycle. And talking to that, as everybody knows, from a Prescient investment perspective, we don't do equity stock selection. So we operate at an index level, but how do we outperform the index is $1 million question, an important question when it comes to our asset allocation, and therefore we use a portable alpha process. Can you uncover a little bit of the portable alpha process for the listeners, please?
Yes, definitely. As I just mentioned, that investing in the index would have provided you diversification. I think if you are just in the market, if you're just tracking the index, there's also a cost to that, right? So one, it's the fees. So when you put in fees, you're definitely underperforming. But secondly, then when technology is going down minus 22%, that means you're also going down minus 22%. There's no tilt to that. So the passive alone strategy is not necessarily so great. And naturally you would think maybe I should go towards active managers. But we've done a lot of research around that, and we find that with equity markets, a large proportion of the time, the active managers are unable to actually outperform the index. So you definitely wouldn't want that either. So what we've done is we want the best of both worlds. right? We want to have the index tracking so that you don't underperform significantly, but also you don't want super large drawdowns that can come from equity active management. And therefore, the portable alpha process essentially just takes, instead of just buying physical shares from the index, what we do is we get unfunded exposure to get access to those shares. And then what we do with the actual cash is then we can invest it elsewhere. So with our research that found that, with equity markets, most of the time you're going to underperform. That is not the case with the fixed income and bond side of things. So there you're able to actually be a lot more active, take more active tilts, and with that gives you kind of a buffer, and that is where we get our excess returns. And therefore, in this environment where you're having such a volatile environment and equity markets are not doing so well, the alpha component, which is from the fixed income side, gives you an element of just cushioning that helps with your underperformance to not be just as bad. And it's even better when the markets are doing really good, because now you have equity markets are doing incredible, but also you have fixed income elements on top of that, and you just then always outperforming most of the time.
Thanks, Dimple. Shreya, turning back to you from an asset allocation perspective, the Rand has a significant implication in multi-asset portfolios. So please let us know how you're thinking about the Rand and the positioning thereof, given that a balanced fund, can use offshore assets.
Yes, Murray, you're correct. So because we have a lot of offshore exposure, we have to consider currency in the equation. So we think of currency as its own asset class, and we're able to actually hedge back a lot of dollar exposure back into rands to protect the portfolio from rand strength. So structurally, we have 17% as a rand hedge in the portfolio, and we're able to upweight that or downweight it depending on what our view is on the rand. Now, coming into 2026, we had a negative view on the rand, and all that means is that we didn't think the rand could strengthen much more than it actually did on a probability basis. Now, coming into March, we've seen the rand weaken, and what we've done is we've incrementally actually increased that hedge. So currently, as Basti showed at the beginning, we have a moderately positive view on the rand, meaning that we think that it could possibly strengthen from its current levels. Currently, we are moderately positive on the rand, and that's been primarily driven by valuations that are moderately positive and a resilient economic picture. Financial conditions and sentiment give us quite a mixed picture. If we focus on the positive drivers of this asset class view, you can see that under valuations, we look at the South African one-year real yield spread versus the one-year US government bond yield. Now, what this is showing us is that it's currently quite positive, and if you zoom in, you can see this upward trajectory quite high above the long-term median of 3%, meaning that under valuations, it's quite attractive. Then looking at economics, so the way that we look at economics, we look at things like South African trend inflation, we look at the South African one-year forecast, and we look more globally to look at US manufacturing as well. Now, we extract the trend of inflation here, and what we've seen is that it's actually moderated, which is quite good for South Africa's growth. Then, if we look at US manufacturing, that's also improved. So from a global landscape, economics is actually quite resilient.
Thanks, Shreya, for that in-depth explanation. Dimple, turning back to you, volatility tests investor behavior, and often in times like this, people make mistakes, and those mistakes long run cost in terms of performance. Can you unpack that a little bit for us?
Thanks, Murray. So as I mentioned in the beginning, that we need to remember the horizon that equities works best in. You need a longer time horizon. You need time in the market, and therefore, in instances like this where there's a global crisis and there's headlines all over, the first mistake that investors are likely to make is to panic sell. Because you think, okay, let me just take my money out, I'll put it back in at the right time. But we've actually done research on this, and that if you just miss a little bit of the entry back into the market, you're actually much worse off than the person who just stuck through the different turmoils in the long run. And remember, equities is a long run game. The second thing is now switching in and out of your processes, right? You need a systematic, unbiased process to help you navigate all of the different turmoils. Right, so when there is a shock, you know and you understand that you're not going to be reactionary, and it's also not going to be based on your feelings. And lastly, the selling in and out of the equity market will cost you a lot. Number one, in transaction costs, there's a lot of fees. You are also locking in losses. These are very important numbers that investors don't really look at so much. And so again, just stick to the process. In volatile times, as we've mentioned, that what we have seen in our positioning, in our research, is that the fundamentals haven't changed significantly to cause panic or to cause completely moving out of equities. There's still space for equities and for long-term investment, long-term performance. So I think that's quite key things for investors to look out for.
Great. Dimple, thanks. I think between yourself and Shreya, we've covered quite a significant amount of asset allocation. Bastian, maybe just to get to the end and close off, we talk about strategic asset allocation in balanced funds, but then also this tactical asset allocation and hedging as a tool to build a robust balanced portfolio over time. Do you want to just cover a little bit of how we would go about hedging the portfolio?
Yeah, definitely. I think for us as systematic investors, we understand risks quite well, and that's key. So we don't just understand where the risk is coming from, but also how significant certain shocks will be. Current crisis is, I guess, a perfect example where we obviously didn't know when the crisis would hit or what kind of crisis it would be, but we still positioned in a good way, achieving good outcomes because we have prepared for all sorts of crises. And speaking about hedging, there's different ways. I guess if I compile it into like the three most important components, the first one in a multi-asset portfolio would probably be the currency. So we do have dollar exposure, which helps you in a period of crisis. Right now, that's not our preferred hedge. We do have dollar exposure, but a little bit of it, less than usual. Shreya alluded to the fact that we're more positive on the rand, so we've dialed that down. A second hedge, which we always have in place, is exposure to US Treasuries, which is naturally a very good hedge in a period of crisis with a market sell-off. Normally there's demand for haven assets, and then US Treasuries would rally. That's a hedge which we have in the portfolio, which also wasn't particularly good this time around because the nature of the crisis hints towards like an inflationary risk, which means it's bad for US government bonds because you're worried about your fixed rate return while inflation goes up. But they've done fine. They've just not been the best hedge. And the third component, and that's a part which actually has helped us a lot, is to enter the crisis with conservative assets which are priced to be attractive. And we spoke about the front end of the yield curve being priced to be quite attractive. That's a natural hedge because stuff just doesn't move that much. And if it moves in your favor because interest rates do get cut, and that part of the curve would then benefit, which hasn't happened now, but it's still earning 9%, not moving. Also want to highlight the fourth and last and probably most important element, which is just broad diversification. So in our balanced fund, we've got 15% exposure to alternatives. And that's an asset class which in this current crisis has not moved at all, which is absolutely awesome and which has created a natural buffer. So it's not about trying to find the one perfect hedge and not just about trying to figure out when that hedge works. It's more about having a whole set of hedges and understanding that they work in different crises differently. But if you have them all at hand, you will position yourself to be quite resilient.
Thank you, Bastian. Shreya, turning to you, I think we've covered a lot in this, in the few sort of 25 minutes or 30 minutes, however long we've been going. Between yourself and Dimple, I think, there's a lot in terms of the mix in asset allocation. I'd like you to just show a positioning of the balanced fund so that everybody that's dialed in can appreciate exactly where we are.
Yeah, sure. This is where the balanced fund's currently positioned. So we've got around 26% in South African equities, slightly higher than our SAA. We've got around 4% in SA property. We've got 10% SA bonds and around 5% on SA credit, clean energy and infrastructure. Then we also still have a little bit in SA income. On the offshore side, we have 16% in developed market equity, around 8% in developed market bonds, and on the emerging market side, around 16%. And then on our hedge, we're currently sitting just higher than our strategic asset allocation at 18%. So this positioning accurately reflects our strategic asset allocation, our tactical asset allocation, and our uncorrelated portable alpha view, which you can't actually see in the pie chart, but it is there, as Dimpo has mentioned, through our equity funds, onshore and offshore. To summarize, this portfolio is very well positioned for any sort of market scenario, and it will change depending on what the scenario is as time goes by.
Agree, Shir. I think in closing, just a few comments from myself before I hand over to Bastian. I think the uncertainty that we see in the world is significant. I think this poses lots of difficult questions for investors and clients about how well to be positioned. Hopefully what we've demonstrated is that our positioning is thoughtful given what may occur over the next few months. But Bastian, maybe in closing, why is it that you believe a systematic approach to tackling these markets is the key approach to be taking?
Yeah, I think it has been a particularly interesting period for us through, once again, very headline-driven markets. And the interesting bit is we get the question quite often being pinpointed towards how do you capture Trump, how do you capture politics, how do you capture an oil spike? And my answer in return is actually how do you capture all of this without a systematic process? Because the reality is markets do react short-term. In the short term on headlines, they are up and down every day because Trump changes his view every day. But our strength is to look through that noise, to cut through the headlines, to look much deeper, to see all of these factors which Dimpo and Shreya have explained in detail. Those are the ones which are driving markets over the long term, and that gives you a great roadmap how to position yourself. And that's what we've done at the beginning of the crisis, where risky assets were priced to give us much lower expected returns, hence we were conservative. And now in the crisis, risk picks up. We measure it through all of these volatility factors. We pick up risk, and markets are set to recover. So it works very, very well if you cut through the noise, don't listen to the headlines, but just use that approach. And I think the current crisis has been a perfect example for that.
Well, thanks to the three of you for sharing those insights. Thanks to everybody for joining us. We will take questions. But in closing, just to remind everyone that our multi-asset team covers a domestic balanced fund, which is a balanced fund without the offshore exposure, as well as our Prescient balanced fund, which includes the offshore. We also have a global balanced portfolio that we offer in UCITS form. And in terms of Dimpo and the equity team, a full range of domestic equity funds that one could utilize if you're not going the multi-asset route. Thanks very much, and we'll start to take the questions. Okay, folks, we're leaning in to get a view here. Firstly, we've got a question that's come up with regards to the Straits of Hormuz. Bastian, I'll pass this one to you. I mean, obviously over the weekend, again, we've seen a lot of activity in the Straits of Hormuz. It's going to be opened, then it's closed, and then tankers are taken. I mean, this is really a challenging environment, especially now concerning second round effects of the supply chain shocks that we're seeing. How do you interpret this, and how is it going to impact our asset allocation views? I mean, these are obviously very fluid activities that are taking place. Just give us some thoughts, given its recent news.
Yes, the recent news changes every day at the moment, so that's fine. So first of all, speaking about inflation, as illustrated in the webinar, we're not that worried about inflation at this point based on the oil shock. Obviously, there will be a once-off spike. That has been seen before on the back of oil crisis. Is it going to be persistent? We don't quite know yet, but our anticipation is that it won't. And it's just important to also remember that markets mostly are not too worried about inflation itself. They're more worried about inflation expectations because that feeds into central bank policy. And if we look into inflation expectations over the long term, the 5-year inflation swap really hasn't moved. So with that, the Fed shouldn't move, and with that, markets shouldn't be too concerned around inflation. They obviously have reacted in a concerned way, and that's exactly where the opportunity lies. And then on global growth, picture slightly different. So we obviously go with what the data suggests. Right now, there's no evidence of any material slowdown. So we're seeing first signs of a little bit of a slowdown. It's very muted. That can change. We have to go with what the data suggests, though. Right now, doesn't really worry us too much. It might also be the fact that the US economy just continues to be very strong on the back of a lot of positive momentum, again, strong labor market, etc. So with that, yeah, too early to say on any of those two that there will be material impact, and that's how we position the funds.
Okay, great. Thank you. Shreya, there's a question related to tactical asset allocation. Obviously, times like this, you'll see dislocations in prices. And are we able to take opportunity when these prices show up that there are these opportunities?
Yeah, 100%. So it does pay to be active in our world, and we are able to take advantage of these opportunities quite quickly. The reason for that is because of the way that we actually implement the strategy itself. So we're not trading single stocks like Apple or Google, where sometimes it's quite difficult because of liquidity to move in and out of very big positions. But because we take index level exposure, so we trade, for example, in the DM equity space, the MSCI World Index, it's much easier for us to actually trade in and out because of the liquidity in the futures. So we use derivatives to get that exposure. And on the cost side, I mean, it is expensive to trade, especially if you're trading quite frequently. But again, the instruments we trade are quite cost effective. And that's why it makes sense for us, and it 100% pays to be active because we can.
Okay, great. One more question. How do you implement your DM equity views where there are divergent views for the various regions?
Yeah, so 100%. So currently our view is moderately negative. If you aggregate the views, that is the position. And in our DM equity space, so we do trade the MSCI World Future there. In that index, the United States makes up around 70%. And so that's why we would trade a more bearish negative view on that. So we would take a little bit of exposure off.
Okay, thank you. Dimple, this is actually a question from myself to you with regards to our equity fund range. We mentioned we've got a broad range of funds. How do clients go and think about the options that we've got available, and how do they implement them in their portfolios?
Yeah, so we've got a range of funds. So, and our strategy is mainly index trackers. So I'll start with the Prescient Equity Fund, which, for instance, is it is index agnostic, right? So we're able to take tilt between the different indices. If we want top 40, resources, financials, we're able to do that. A top 40 would give you exposure to the largest companies that are listed in the South African market. All Share gives you a broader version of that, and it taps into the small caps and the mid caps. And then we've got global funds as well. We've got a global MSCI fund which tracks the MSCI World, which then will give you exposure to what you typically wouldn't get with South African markets like global technology. And then we've got emerging markets as well. Emerging markets then gives you exposure to the global space, but more for developing countries. You're tapping into China, India, Brazil. So firstly, all of those strategies, we run the portable alpha strategy on. So it's just about the investor's appetite on what they want exposure to. But then, as explained, the portable alpha strategy is a superior strategy, and we are running across all these different funds.
Okay, great. Thanks. We seem to not have any more questions, which is not a bad thing. Maybe we explained ourselves sufficiently. I don't know if there's any closing remarks from either of you. If not, yeah, I think really what we described today in the webinar is from a multi-asset perspective, we've got a full range of funds, and obviously the strategic and tactical asset allocation that we implement is really designed to outperform those long range targets that we have. And from a returns perspective, we can demonstrate that we've done extremely well, and reminding our clients to always look at the fact sheets and have a look at the price that we offer these funds at. Our annual management fees are very compelling. It's a strategic approach that we have, so it's always a feature that we like to talk about. And then I think importantly, as Dimple shared, again, in the equity fund range, we've got a full spread of options for investors, particularly those that are building portfolios using single asset classes such as equity. So we've got a number of funds domestically and internationally that can be utilized. Without further ado, I'd like to then say thanks again for joining me, and to everybody that's dialed in today. We appreciate you joining us, and we look forward to having you again on one of our webinars. Thank you.
Thank you.
Thank you, Murray.